Hi, everyone, and welcome to the week ahead. My name is Tony Nash. Today, we're joined by Mike Singleton, Albert Marko, and Tracy Shuchart. We're just coming off of a Fed meeting. It's Thursday, so I just want to start at the top of the show, just getting everyone's reaction to the Fed. 50, some people called it, some people thought it'd be 25. I think we were going to get a cut anyway. Mike, welcome, first of all. Thanks for joining us. I really appreciate it. What did you think about the Fed? What's your reaction? Did you expect it? Is it time? How will the market ingest it? What are your thoughts?
So first, my expectation was for 25, not 50, but I'll answer your question in two parts. From the perspective of a policymaker, I don't really think 50 basis points made sense. Why? Well, because the economy doesn't really need stimulating. And ultimately, when the Fed cuts rates, that's stimulus. But right now, what you're seeing is an economy that's really already reflating, right? We're looking at 3% real GDP growth. That's 150 basis points above long-term potential. The unemployment rate, which has been the big red flag that everyone's been worried about, ticked down 10 basis points month over month last month. Inflation is above target and accelerating by at least a couple different measures. In August, core CPI printed 3.4% annualized. Wholesale inflation printed 3.9%. We just got the Philadelphia manufacturing outlook this morning. Prices paid just printed the highest level since Q4 of 2022. There's decent evidence that the U.S. economy is reflating and stimulating.
And industrial production is up.
Right. And almost all of the growth data looks decent and a lot of it's improving. And some of it looks really good.
Yep.
So from a policymaking perspective, 50 basis points doesn't make a ton of sense to me. From an investor's perspective, the more stimulus, the better. At Invictus, we were already positioned long because we believed that the economy was reflating and economic conditions were supportive. So from the perspective of a U.S. investor, maybe a stock investor, of course we like it because it's good for stocks.
Yep. Great. Albert, what are your thoughts?
I mean, my thoughts have been crystal clear since January when I told you that we're going to get a rate cut in September before the election. And, it's quite clear to me that this is just nothing more than a political operation to help Harris and the Democrats and, Brainerd and Yellen and Powell stay in power. And that's what they did. And that's, it's nothing. I mean, I'm surprised they did 50. It's kind of ridiculous, to be honest with you. I mean, for everything
Right.
Michael just said is, that's not right. I don't think they should have done that. And then they tried to come in with the presser and say it's a hawkish 50, which I just laughed. I mean, I'm just, come on, man. I'm like, this is, I mean, we're probably looking at another inflationary event in 2025. So,
right. It's like, why are you tipping the wait staff 50%? Oh, it's budget cutting.
Yeah, I mean, it's just more asinine things by Janet Yellen. She'll be gone anyway, so she doesn't really care. She did what she had to do, and that's about it, really. I mean, we've been crystal clear about the September cuts. It's like, January.
Right, exactly. Yeah. Tracy, what are your thoughts?
Well, I thought it was really interesting because it seemed like they were using the labor market as an excuse to cut 50 basis points without regards to what this would do to inflation. And so my thoughts here is down the road, for whatever reason they may have done 50 basis points, they're solely looking at the labor market is going to be a big policy mistake, because we are, and again, I agree with Michael, we're going to see a resurgence in inflation due to this. So we'll have to see how this pans out. Of course, this will take a few months to pan out. But again, like I said, I think it was really interesting that they used the labor market only as the reason to cut 50 basis points.
Yeah, maybe by the labor market, he was talking about one particular job in the White House. That could have been it. I also thought it was interesting. He talked about we're doing this to protect downside risks. I mean, there's always some downside risk. You can always, cut.
Downside risk to what, though?
Exactly.
And he was very unclear. Exactly. He was very unclear on what he said. I mean, he couldn't even say the word recession.
Right.
When There was a
downturn.
question that somebody asked, he said, recession, I mean downturn. He caught
Right.
himself. He couldn't even say the word
Right.
recession.
He's a terrible liar. And as you tweeted, Tracy, his coughing or clearing his throat or whatever is a huge tell that something's coming, right? And so it's just weird. I actually thought that Powell has handled things pretty well to date, even through 2021 when everyone was whining. I thought actually they did things pretty well. But this one, I think I get the sense that, you know, you get levels of respect for institutions. And this is one that kind of, I think, erodes respect. Whereas through the COVID crisis and, you know, through the tail of it, I think they had done pretty well. But I think this feels like a little bit too much. And so will markets boom on it? Yeah, but you'll also get commodities booming, right, Tracy? I mean, we'll start to see
Absolutely.
oil
This
come
is going to
back.
be the problem. We've seen metals surge. We've seen base metal surge. We've seen like metals like nickel and aluminum that have been in the lithium that have been at the depths of despair.
Right.
Suddenly, you know, come to life again. And
Well,
so this is going to be obviously a problem when we're talking the commodities industry in general. Now, oil hasn't reacted much to this, but then again, you know, you have to realize that the oil markets are more correlated to 10-year yields, 88%, than it is to the US dollar in this situation.
right. And Albert's been telling us for about a year to beware of resurgence of inflation in Q4, right? Q4 or Q1 of 25. I can't remember when you said, but
Yeah, well, I mean, it's a little bit fluid because because these policy actions.
right. But this probably pulls it a little bit earlier, right? So
Oh, I mean, they can like Tracy said, oil is correlated to the 10-year, which the Fed controls anyways. They control 70% of it, so they can sit there and manipulate that up to a certain degree because the bond market is getting more tradable now by multiples. So it's going to be more difficult for them to sit there and screw around coming Q4, Q1 of next year.
right. Okay. And then just to close out this Fed thing, with the dollar, so will this make emerging markets more attractive to people who may have parked money in the US, given, you know, relatively higher interest rates? Michael, what do you think about that?
Yeah, I think the answer is yes. In general, a softer dollar improves the credit quality of emerging markets. It makes their dollar-denominated obligations, including debt, less onerous to service. And if you looked at, I mean, I think that should make sense logically, but if you want evidence of it, you can look at the performance of emerging market currencies relative to EM credit spreads, and they're highly inverse, or something like a negative 80% correlation. It's a consistent correlation over the long term. And of course, the correlation between emerging market stocks like the ETF EEM and the Dixie Dollar Index is also very close. It's a closely inverse correlation. So yeah, I think emerging markets should perform well over the next 3 to 6 months or so. Doesn't mean that I want to be out of US stocks. I think US stocks will perform really well too.
You put out a tweet earlier this week. This was before the Fed meeting where you said that you were looking at a bunch of charts, and you said this is a market that wants to go up regardless of what the Fed does. But you said even though we're almost overbought into a risk event. Can you talk us through what charts were you looking at and what risk event are you talking about, and what does almost overbought mean?
It means they've gone up. Overbought means they've gone up quickly off of the August 5th bottom. The risk event was the FOMC meeting. And why did we think stocks were going to go up afterward? A variety of reasons. The technical reasons that I was referring to there is we run a variety of proprietary screens at Invictus for long ideas and for short ideas. And when we were looking at our short ideas, so these are these stocks that we think theoretically look the worst, they didn't look bad at all. They looked like they were breaking out. they're demonstrating highly convex price action to the upside. And so when all of your best short ideas look great, generally speaking, at least in our experience, that's a good sign the market's going to go higher, at least in the short term. So that's what I was referring to.
Okay. And so how did the Fed meeting change that? It just made things more attractive for the short term?
Pretty much, yeah. I mean, I think when the Fed cuts rates by an unexpectedly large amount, that resolves the risk of less dovish policy, and so stocks resolve to the upside, and that's what we've seen so far. It doesn't mean we can't see pull back in the next few days or whatever, but I would say right now economic conditions, monetary conditions all look pretty good if you're a stock investor.
Okay. And so in terms of sectors, do you see rotation back into tech given the Fed moves? Are we going to start to see tech perform again, or are we still seeing the rotation into a little bit more conservative sectors?
So I would start by saying I'm not really bearish on tech. I think that the structure of technology stocks overall looks fine. NVIDIA, which is the poster child, is still in an uptrend. It looks like it's getting or gotten oversold within an uptrend. And historically, that's been a great time to buy. I don't know that technology is where I'd be looking for my best new long ideas. I think there are some other sectors and industry exposures that look better. I think biotech looks better. I think regional banks look better. But, if the market is going to perform well over the next 3 months, 6 months, 12 months, I don't think technology stocks are going to do poorly. I think they'll be fine. They might not lead like they have been, but I think that they'll do just fine.
Okay. Why the interest in regional banks?
So I think probably the most obvious reason is that the yield curve is already steepening and very likely to continue steepening. You have the Fed pushing down front rates by cutting. You have them running up long rates, at least theoretically, by running QT. So as the yield curve steepens, net interest margins for banks should widen. As the economy accelerates, they should be making more loans. Loan growth should accelerate. So you have a nice combination of accelerating loan growth plus more profit per loan. And historically, if you just run a back test, when the yield curve is steepening, regional banks perform much, much better. The T-stat is something like +2 when the yield curve is steepening and -2 when it's flattening. So this isn't exactly right, but it's almost 4 standard deviations better against a steepening yield curve. So we think regional banks is a very good place to look for new ideas.
Right. Okay. So do you think the commercial real estate risk is mitigated, at least for now, with the regional banks?
So generally risk materializes when economic conditions are getting worse. Right now, economic conditions are getting better. So it's not to say commercial real estate isn't something that could be a problem. I don't think it's going to be a problem while GDP is growing at 3% and improving.
Okay, great. And so where do you see the kind of where you're not interested in looking right now? And given the Fed and given some of your analysis over the past week, what things are you not interested in? I'm not saying they're crashing. I'm just saying, what are you just taking a pass on right now in terms of sectors?
So a lot of people right now on Wall Street are getting excited about long-term government bonds. I don't think that makes any sense. Issuance is going to be significant. The Fed's still running QT. The economy is reaccelerating. All of these are backdrops against which long-term treasuries tend to perform poorly, if not in relative terms, and very, very likely, if not in absolute terms, then very, very likely in relative terms. In other words, stocks should really be outperforming bonds from here. So despite reasonably good performance from long-term bonds over since April, call it, not interested in getting involved there. Defensive equity sectors like staples and utilities, think those are considerably overbought.
Okay.
We would be overweight more cyclical risk exposures within the equity market and underweight the defensives.
Okay, that's great. I love that view. That's really interesting. Okay, you mentioned bonds, and we talked earlier about commodities. You put a tweet out about saying commodities and bonds are sending a much different message about the economy than stocks. Current price action implying a very, very sharp drop in nominal GDP growth. So can you talk us through that as well?
So it was a little bit of a provocative tweet because what the commodity market and the bond market,
that.
Yeah, our pricing in is a little different from what the stock market is pricing in, right? The commodity market's getting a lot of China. I'm sure Tracy can speak to that better than I can. The reason that treasuries were performing as well as they were is because they're pricing in a lot of cuts, right? We've seen that. We've seen it unwind a little bit, but essentially with long-term bonds, we haven't seen anything in term premium over the last year, really. Term premium has oscillated within, call it 25 basis points. So all of the price action we've seen has been explainable by interest rate, short rate expectations from the Fed. So really the reason that it looks like the bond market is anticipating a sharp decline in growth is just because the bond market was anticipating a lot of cuts really quickly. And in this case, we think there's a disconnect between what the bond market is pricing in and what's actually going to happen. Can get into that for a variety of reasons. But again, it's another reason to stay away from bonds, right? If the bond market is pricing in a lot of cuts in anticipation of a very soft economy, we just don't see that happening. And we think ultimately it has to reprice and yields are going to go up again.
Okay. Can you give us a couple of those reasons? I know you probably have about 15 of them, but can you walk us through a couple of those reasons?
Well, the federal government is spending $2 trillion and the Federal Reserve is stimulating. Both of those things tend to improve real growth conditions on the margins, and real growth conditions were already good to begin with. So you have an economy that's already doing well, at least by all of the different measures, government measures of economic growth. And then you have policymakers pouring gas on the fire.
Yeah, it just seems, something just seems too good to be true. I don't know what is going on, but things just, like you say, pouring gas on the fire. Why? Like I'm still scratching my head over some of these moves. But I think what you're talking about is very solid and it's very interesting. Albert, you've talked about long bonds over the past few months. What are your thoughts on Mike's takeaway?
I don't agree with it. I don't think that the stock market has much more to go. I mean, we've already doubled for where it's been in 2 years. I mean, you're talking about an economy that's completely artificial. It's not real. I mean, job losses are mounting. The only things that they provide on the government data is completely manipulated in every which way you could think of. So, I mean, but then again, it really depends on what happens after the election. I mean, if you have a split government, that's very bullish for stocks because they have somewhat of a base case where things aren't going to go radically one way or another. However, if there's a Democratic House and Harris is the administration throwing in Brainard and Gensler with 2 Republican senators that vote liberal all the way through, I mean, you're talking about the dollar most likely heading down into the 80s, and inflation gearing back up again. And then we're talking about, rate increases in 2025. So I don't really see a case here where the ES could probably, go over 50, 5850, 5900 in the next 6 months or 12. I just don't see it.
You don't see like a 7,500, 8,000.
Oh God, no. Oh God, please no.
I'm going to have to be a little bit extreme. So.
Absolutely not. And on top of that, I already know some of the big boys are already buying into Asia. They're already setting up funds to go moving money into Asia. So it's just, even from their perspective, this market's way overbought as it is. It's way overvalued. I mean, what are you going to do? What are we going to talking about here? Like Nvidia at $200 a share? I mean, where do we go from here?
Yeah, it's so I get the sense, and guys, tell me where I'm wrong. I get the sense that we are in this magical point from here until the election. And there's almost no downside from here until the election.
I agree.
And then once we get to the election, it's decision time, right? But either way, either candidate, there is inflation. It just depends on the degree, but they're inflationary. And, either way, we have some policies that are expansionary. So they're going to be, as Michael said, kind of pouring gas on the fire, regardless of which way we go. But I think reality hits after the election. Is that fair? So for the next, say, 7-8 weeks, we're kind of in a magical land where not that you can't lose, but where things are all good for the next little bit.
Yeah, I mean, they've already shown it. I mean, we're almost at 1,500 today. I mean, what do we, I mean, what have they shown otherwise? They don't let this market go down.
Right. Michael, what do you think? Are we in this magical zone, and what's the risk of that changing post-election?
So, I can't see the future. I will say I think the risk is probably a little lower than Albert is guessing. And the reason I say that is because no one has any incentive to cut government spending. And while government spending has a lot of negative consequences we could talk about ad nauseum. All else equal, the more money the government spends, the higher corporate profits go. And there are a number of accounting identities that you can use to deduce that. There's a Kalecki levy profits equation. There's a sectoral balances equation. You know, the bottom line of which is the more money the government spends, the more nominal corporate profits growth goes higher. So unless there is a commensurate policy response from the Fed, you know, that's stimulus. And if we see 12 or 13% growth in corporate earnings year over year, there has to be some reason for the stock market not to keep up with corporate earnings. And I just don't know what that is right now.
Oh, that's fair. Tracy, what do you think? Are we kind of in this magical zone until the election? And then are you waiting for some turning point once the election happens, or do you think we're kind of on a glide path post-election?
I think that, you know, I think that we're on the upward trajectory into the election for certain. And I think that there'll be some sort of euphoria no matter who is elected, depending on the sector that you're involved in, right? Because they're two completely different administrations with two completely different agendas. And so you're going to see euphoria in certain markets and downturns in certain markets, depending on who is elected. I think that'll carry us over. And I think reality will hit, you know, in the beginning of 2025. And then we'll really see the implication of, you know, what, you know, particularly if the Fed cuts another 50 basis points, which is in the dot plot right now, that'll start filtering into the market in addition to the elections and the actual inauguration of the next administration. And so I think that's when you're really going to see everything kind of come to head, and the market's going to decide, you know, what are we going to do here? And typically, you know, Q1 is not very good for markets in general anyway, or I should say January is not very good for markets in general.
No, that's great. Okay, perfect. Thanks for that. So since we're talking so much about government, Albert, let's talk about this piece you wrote this week for Cloak and Dagger. You have been talking about US Treasury shenanigans for years now. So can you talk us through, this article is titled "The Assertive Role of the US Treasury in Propping Up Market Activity." Can you talk us through that? Kind of, why did you start to catch on to Treasury's intervention in markets? What intervention is Treasury doing, and what will that do to a post-Yellen Treasury? So that's a lot. I'll come back to those questions if you don't.
Yeah, I mean, I'll just summarize it. I mean, there's nothing it's nothing new than we haven't talked about before. But I mean, the Treasury, well, specifically Janet Yellen, has made it a mission of hers to keep the market rallying until the election, specifically to help Democrats. I mean, she's used the TGA in multiple ways. She uses the primary job is to manipulate the bond market, especially the 10-year and on, the long bond. You know, they own about 70% of it through themselves and proxies, and they can sit there and build charts and do whatever the hell they want to do because they own, like I said, they own 70% of it. So, you know, previously, you know, before Yellen's time, they were using unsteady banks to do such things, right? But now they know that they can use government money, which is, you know, free and clear of funding being pulled, like they used to do to banks when they got in trouble. So, you know, they don't really care about fundamentals, and that's quite clear. I mean, that, you know, I even about 2 years ago, I was like, well, I'm gonna, you know, bet on the Fed doing the right thing and so on and so forth. And then every single fundamental chart got just absolutely annihilated, right? As I was trying to short it, right? Trying to get, like, you know, fundamental base cases of this and that. And I just got railroaded, right? And at that part, after that, you know, speaking to a few guys in the, you know, DC and whatnot, and even Wall Street, it's just like, it's clear, man. They don't, this is a government op. It's an election op. That's all it is, and it will remain so. My fear is specifically what Tracy said. After the election, they'll have, you know, a pop in the market to, you know, to validate, you know, the election turnout. But, you know, they can't lie forever. It's just, you know, the roost, you know, the chickens are coming home to the roost real quick. Well, come 2025. especially
so-
if job losses mount up. They can't keep using immigration numbers to manipulate the labor market and justify Fed policies much
Right.
longer.
So do you think the magnitude of intervention of Treasury started post-COVID in probably a good faith way to get markets kind of back on track? And I mean, this is the assumption I'm making, right? I'm making a good faith assumption that it started in a good way and it worked really well. And then they just thought, wow, I can't believe how easy this is. Is that kind of the thoughts you're having?
Yeah, this was Mnuchin's idea to begin with, right?
Okay.
He didn't implement it in the way that Yellen did. Yellen absolutely weaponized it for political purposes. But it is 100% started during just before COVID actually, and then he started using it during COVID, and Yellen took over and just went bonkers.
Okay. And so can you give a couple of examples of how those interventions happen?
Well, the long bond market, first and foremost. That's what, they pump the long bond market. They'll crush oil prices. The bond market rallies and tech rallies, and therefore, because Mag 7 is so overweight in the market rallies. I mean, Nvidia goes up 5%, the entire market goes up 1%. It's crazy, and it's just not right. I mean, you can see it in the Mag 7 performance over the S&P. It's just way outweighted.
So you're telling me that technology isn't as amazing as market returns say?
No, I mean they're way overvalued. But on the flip side, it's like, if it's a government operation and it's a national security thing, and then why would you bet? Why would you bet against it? You know what I mean?
Right.
Why bet
Yeah,
against it?
that's the whole thing.
Why bet against it? I mean, I don't like chart guys, right? Sorry, Michael.
That's all right.
But
I'm a chart guy, so it's okay.
But if they're building a case on a political idea, they're using charts. They'll build your charts, and charts actually show you a roadmap of what they're going to do.
Right. So, okay. So this sounds like a tool that's been used, and it sounds like it's really hard to put back in the box.
Oh, it's really difficult to put back in the box, especially when you don't have a Congress that'll step up and question Yellen with any kind of real, venom.
Okay, so is it possible to get transparency on this activity, or is it just kind of triangulated inference?
No, you can only triangulate it. You'll never see any kind of clear cut evidence unless someone from like the big hedge funds, leaks out conversations. But maybe that'll happen in 5-10 years. Who knows? But
Okay.
not in the meantime.
Okay, so it would have to be conversations leaked out and that sort of thing. Okay.
Of course, but you even see hedge fund guys coming out now. I forgot who it was today that said that the market is screwed for 2025. Right? If it was I forgot the guy's name. God damn it. I should have wrote it down. But even he's like, this action is not right. Can't last. Now he might be saying that because he wants to get into EMs, but everyone I talk to on Wall Street, and these are big boys, are just not keen on this market going forward.
Right. Okay. Interesting. So, so next administration, Lil Brainerd, or I have no idea who Trump would put in that place, but or Gensler.
It's Besant. Besant would be Trump's guy.
Okay, so one of those 2 or 3 get in based on who's elected.
Mm-hmm.
You're telling me they're going to continue to use these tools, right?
They will, but you need a congressional makeup that favors you. If Trump won, but it's a Democratic Congress and Senate, he's not going to be able to do much. If Harris wins with the congressional House and the Senate that's 50-50, you can say hello to dollar going down to 85 quickly.
Okay. And I should have asked this before, but how much does the efficacy of this have to do with the fact that Yellen was the Fed chair before? So she knows how it works.
A lot.
Right.
She knows the ins and out of the Fed, exactly the mechanisms and who they use. She knows everybody at the New York Fed, right? That actually does trading for the Fed.
Right.
She knows them all.
when I read this, and we've talked about this over the years, what I thought of was she knows the right strings to pull at the Fed to get alignment with whatever she's doing at Treasury. Whoever comes in next won't have that. Maybe Brainerd would, but she wasn't the chair. But they don't necessarily have the knowledge of the Fed that Yellen does.
Yeah,
So it may
exactly. I
not
mean, you can
have
see,
the efficacy that it's had under Yellen.
yeah, I mean, you can see Auntie's bullshit in live. I mean, she's talking about raising yields, 20 basis point, like that's going to save the dollar. It's not going to save the dollar. Their entire policy is absolutely geared towards the dollar going down.
I haven't checked the Dixie today. Is it still above 100?
I think it was threatening going under 100, and that's all I saw. I didn't really pay attention to it today.
Okay.
I'm not really paying attention to this market until after the election.
We're at 101.70.
Okay.
Yeah. No.
Okay. So you're telling me efficient markets hypothesis is not a real thing, Albert?
No. Come on. I mean, if it's not crystal clear, the market doubling in 2 years is, on basis of what, Give me a base case of why this market's up. If you strip away Mag 7, tell me why the market's up.
Well, without margin expansion due to inflation, it's really hard to justify, right? I mean, we saw margin expansion on the back of inflation from a lot of companies, but with the rate of inflation coming down, you've seen people have to really fight to keep those.
Look at the revisions on the job market, for God's sakes, right?
Yeah.
Give me a case now.
Okay, but here's the deal, okay, because I'm the first one to complain about revisions. So I am, but you can't trade the revisions. So why does?
No, I get it. I'm just ranting because of the political components of it, right? You can't really trade on the political components unless you know something, right?
Unless you know what's going on.
Yeah, you can't. You have to use guys like Michael and Tracy, right? When they know the charts and the fundamentals if you want to trade. Right. That's I'm just ranting on the political pathway of what's been happening, what's going to happen.
Okay, but it's important context to understand, right?
Yeah, it's just
tradable?
It's a variable risk. It's just risk, right? The stuff that I talk about is purely a variable on risk.
Okay. So Michael, you hear about stuff like this. What do you think? Do you believe it's possible?
I mean, does the Treasury have any impact on where the 10-year trades? Yes. I think Secretary Yellen is very smart, very competent, and also an ideologue. So I think all of this is extremely possible. It's not my area of specialty. Albert probably knows a lot more than I do, but I would say on the face, like, yes, of course it's possible. Listen to Secretary Yellen talk, and she's a political person. I don't even think she would deny it. I think she's pretty forthright about it. I would say in terms of the release valve of all of these policy decisions, what does it look like? Ultimately, I think that it materializes in inflation probably in 2025, like I referenced maybe 20 minutes ago or so.
Yep.
A lot of leading indicators for inflation are sort of picking back up.
Yep.
And, the reason is because consumption is running hot relative to real output growth. I think we're running probably as hot as we're going to run in terms of real output growth. And so the release valve from here is probably inflation. And I think the implication of that is most, government measures of inflation are going to bottom between 2.5% or 3% year over year. And I think they're probably going to end up around 3.5% in mid-2025.
Yeah.
Michael,
and I don't think they care. I don't think the Fed really cares that much.
Michael, did you see any risk on credit card debt going into 2025? That's pretty high up there.
Yeah, it is. It's definitely pretty high. I can't say it's something that I'm especially worried about it when you look at the credit risk profile of bank books in general. Like right now, it still looks okay. And my suspicion is if you ask me which way are credit card delinquencies and defaults going to go over the next 6 months, I think they actually probably go down. And the reason is because the government's going to continue to spend money and the Fed is stimulating, and I think the labor market's going to improve on the margins. And when you see accelerating employment growth and accelerating wage growth, generally you tend to see credit risk improve rather than get worse.
I'm just worried about consumption going forward. I mean, people have used credit cards to just pile into all sorts of stuff, but
I think there's a lot more room for credit cards to grow. I don't disagree with you, but when you look at credit card debt relative to GDP in past consumption cycles, it's gotten a lot higher, which is just to say, I think it could go higher again.
Yeah, I don't necessarily know it's above my pay grade, but it's just something I was curious about.
Great. This is great, guys. Thank you. Tracy, let's talk about energy for a little while. Okay. You put up this tweet about EV insurance. So the rates of insurance for electric vehicles. It's an interesting thing that you've covered for a while. Can you tell us, why is this happening? Why is insurance going up? And what's the impact, overall impact on the cost of a total cost of an EV because of things like this?
Well, I think what people need to look at is that, and I've been covering this literally for at least 2 years now. Where insurance rates, your premiums are going up even if you own an ICE vehicle, because the more EVs that come to market that people need to insure, their premiums are going higher. And so that's ultimately going to affect what your premiums are, because it's the same insurance company.
Yep.
You know, no matter who you're insuring through, State Farm, Allstate, Geico, whatever. And the problem with EVs is that most often what they find is if you have a battery issue, that's $25,000. If you have an accident, they say over 80% of accidents in EVs have to be chalked up as a total loss, where, you know, it might be $5,000 or $10,000 problem with an ICE vehicle. So what the insurance companies are finding, and why it's so expensive, is to replacement parts are outrageous, particularly with batteries. And if you have an accident, the problem is there's not enough people that can fix those vehicles. And so they have to chalk it up as a total loss. And obviously that ups insurance rates for everybody across the board, because they're all insured, you know, they're insuring EVs and ICE vehicles. And basically that's the juxt of you know, why we are seeing insurance policies going, or insurance part of the reason why we're seeing insurance premiums go higher for the rest of us that drive EV or ICE vehicles.
Okay. Can we throw a subsidy EV insurance to make that a little bit easier on
Right?
people?
They should add, Audrey, right? If you buy an EV, you can get insurance subsidies. That's never going to happen.
Yeah. So staying on kind of green, you mentioned a report that said that governments would pay to turn off green grids. I think you said this decade, or the report said this decade. It's
Right.
interesting, not just that finding, but why, but also who backed this report.
Right? Exactly. Absolutely. This was actually a report from a company called Generation, which is actually funded by Al Gore, climate grifter himself in general. Which is very interesting, because generally you don't see these kind of reports from that kind of
Advocacy group, we'll say.
yes, I was trying to be nice about
Right.
it. I was losing that. So yeah, so it is from an Al Gore backed advocacy group. We'll use your word. I like it. And what's interesting is what I think they're coming to the realization is, and what we are seeing in real terms and have been seeing in real terms over the last 5 years, at least 5 years, and particularly since the Ukraine invasion over, you know, that sent the energy markets on head.
Right.
Particularly what we've seen since 2022 is that, you know, you can put all of these windmills and solar panels that you want into the grid, but that doesn't improve grid efficiency. And this becomes the problem. And grids can't handle the inefficiency of intermittent power.
Right. And we've talked many times about how higher interest rates make those grids more expensive to maintain and build. right? So they work in a ZERP and NERP environment, but it's really hard to maintain and build them with real positive interest rates, right?
Well, exactly.
So-
And
So
Go
what
ahead.
happens? What fills that gap if they're turning these green grids off? Is it
Well,
nuclear?
Well, yes, but what fills the gap is we need grid infrastructure, right? We need grid spending. And I've harped on this for years now. You want all this energy. We have growing energy. And this is, when I very first started talking about green energy, I mean, we need to build out grid infrastructure because power is only growing. Particularly, we can look at just in AI data centers right now, how
Right.
much power is going to be needed. I've posted about this several times. And so, really what's needed is we have aging grids here in North America. We have aging grids in Europe in particular. We have the aging grids in South America, even though it's still kind of a younger build out emerging market economy, they still
Right.
have aging grids in some of the bigger markets there. And so really you need a lot of spending, and nobody wants to spend money on infrastructure.
Well, they
And
don't want to
building
spend
out
on legacy infrastructure, but if it's under
Right.
something new and nuclear becomes interesting,
Well,
then
yes,
maybe that's
and
the
that gets
ticket.
Yeah, and that gets me to, I just wanted to kind of give a little bit of background on
Yeah.
that. And so, and then you asked what would bring us kind of forward in this, and then it's nuclear. I
Yeah.
mean, even though we've had pushback from Germany and sort of some DM economies, particularly in Europe, that have pushed back against this, I think they're going to have to start to change their tune, because what we're seeing in emerging markets in particular is that they are looking forward to these new technologies, particularly when we talk about small modular reactors, right? SMRs, right? They're uptaking this over, say, solar and wind, just because it's more economical, it's cheaper over the long term, and it's doesn't stress the grid as intermittent power sources do. And so
Okay.
that's why we're seeing kind of emerging markets and everybody, this big push towards natural gas, which is much more clean burning than, say, coal, obviously, and any other kind of.
As a Texan, I want nat gas to be the solution. So
Of course you do. We've got a lot. We've got a lot.
So we've got a lot. So does it sound like, or what it sounds like to me is nuclear with kind of battery technology and new infrastructure? Is that kind of where we're heading in some of in the US potentially, but also in some of these emerging markets that are taking these SMRs?
I think what you need to look at really right now, as far as where you want to see energy advance, it's going to be emerging markets at this point, because they don't have the infrastructure that we have built out already. They don't have, so it's easily integratable to build out nuclear technology, to build out nat gas infrastructure, right? Because they're going from zero to what, or heavily into coal and to move into natural gas, or and this is more economical for them over the long term than trying to go from zero to wind power to what. I mean, they already have intermittent blackouts. You already look at South Africa is the biggest example. They already have rolling blackouts. Why do they want to add more intermittent power to have more rolling blackouts right now? And they are finally kind of waking up and looking forward to more nuclear and natural gas, which is great for them because their energy infrastructure is horrid.
Okay, so to Michael's point about, EMs becoming a little bit more interesting, at least with these Fed moves, do you think this can create a window for people to raise funds in EMs to do these types of projects, whereas maybe 6 months ago they couldn't?
Absolutely. I think the window is definitely, depending where you are. I mean, I would say it would be a lot easier to do this in South America, for example, because there isn't as much as much corruption as you see in Africa.
You mean as much corruption
in
as
Africa
in DC or in where?
or DC, but I think that market in particular for energy, I mean, we like South American markets for energy, kind of
And what would you look at for
going
that?
forward.
Is it the energy companies, or what would you look at if you were developing a thesis? What segment would you look at for that in South America?
I would say I would look at kind of what establishment markets are actually doing, like a PBR or EC, or what's going on in those markets, and decide whether you like the policies that are going on there.
Right.
And look for joint, like who are the Western companies that are investing down in South America, and why?
Right.
And what direction are they going at? And that includes Canada as well as the United States. Look at like where Canadian, particularly Canadian natural resource companies, because they have a lot of
Interesting.
investments in South America, which look particularly attractive. And so I would look generally towards that sector. If we're talking alternative energy sources, the Canadian market is actually, kind of a better guide to where I would be looking to invest, particularly.
Sure. Smaller domestic market, so they've got to be more aggressive globally. Michael, does this make sense to you? Are there, what thoughts or questions do you have on this?
To be honest, it's not really my area of expertise, although I think what Tracy's saying makes sense.
Right.
If I had 2 cents to add, it would just be that I think energy infrastructure is one of the most productive investments a country can make. So if you're a policymaker and you're looking to improve your prospects for long-term economic growth, making energy affordable as possible is virtually the best thing you can do.
It's great. Okay, on that positive note, guys, thank you. Michael, thanks for joining us. This has been great. Tracy, as always, thank you. And thanks to Albert for joining us. Guys, I really appreciate this. Have a great weekend. Have a great week ahead next week. Thank you. Thank you.
Thank you.